The Ensemble podcast is intended for professional financial advisors. All discussion is limited to publicly available information and should not be interpreted as legal, professional, or financial advice. Ensemble does not hold an AFS license nor provide any financial services. Before making investment decisions, you should obtain financial advice from a qualified financial advisor.
Hi everyone, it's Neil Rogan here from Russell Investments, and today I'm joined again by Alex Cousley, our Strategist and Portfolio Manager for Russell Investments here in Australia and New Zealand. Alex, as you know, I've been out of the country for a couple of weeks and quite a lot seems to have happened in that time. Firstly, with the ASX reaching a record high, I'd be interested to get your views on what the drivers have been for the ASX to reach that record high over the last couple of weeks.
Yeah, absolutely. So, I mean, it's not just the ASX that's hit a high either. The US has kind of just kept hitting highs, what feels like every day. I think that there's two pillars. The first is the economy has generally been okay. Mm-hmm. Corporate earnings aren't that exciting in Australia right now. It's been pretty soft. But to the extent that they're not getting worse, that's an upside at this point in time. I think the second one is around just general risk sentiment. So you probably know, we have a sentiment model that we use at Russell that we rely on quite heavily for tactical decisions that shows, are we in big signs of panic or signs of euphoria? We hit really big signs of panic in April, and we've probably unwound most of it now, but for quite a while, we were still oversold even as markets were rallying. Mm-hmm. And so as of, I think it crossed over last week, we went from oversold to very, very modestly overbought. So that just unwind of panic, that unwind of worry and people getting a bit more confident has been the key driver. And then I think the economy has held up relatively well. The global economy has held up pretty well. And generally the tariff developments have been better than most had expected.
So we're moving out of panic. Things are settling down, and through things settling down, investors are now reinvesting. Would that be a fair assessment?
Yeah, and that's the dynamic that's going on at this point.
Mm-hmm. Okay. So you mentioned the tariff piece. Clearly over the weekend, we saw the announcement that Australia will be now buying beef from the United States. So does this mean that we'll all be eating ground beef from the Dutton Ranch, or does it mean that that this is just an olive branch from our Prime Minister to reach a deal?
So selfishly, I stopped being vegetarian at the end of last year, so I'm quite excited to try US beef. It is an olive branch though. Like Australian beef imports are generally pretty low, but it is that kind of olive branch. I think it reflects as well what we've seen in other negotiations. So some countries have been hit harder than others. So Vietnam got 20% tariffs and 40% on transshipments. There's been a lot of excitement that the US demand for Chinese goods has plummeted. What's actually happening is China is just sending stuff to Vietnam and Thailand, and then they're sending it on to the US. There's no real change in demand. Japan got a better deal than what people had worried about. Mm-hmm. And a lot of that was olive branches of effectively Japan saying, we'll put more money to work in the US. Most of those announcements had already been made. And then we don't know the number yet, but the EU and the US apparently have come to a deal. And I suspect it will be something similar with olive branches being thrown to the US. The one that isn't solved is China. And I think the news has been okay. The big bit was the US allowed NVIDIA to sell chips to China again after having banned them, which is pretty material when you think that AI is at the kind of forefront of some of this strategic rivalry right now. So I think that's a generally encouraging sign, but we'll have to wait and see when the official announcement comes out.
Mm-hmm. And more broadly around the grounds then, Alex, so the tariff piece, I noticed markets took a little bit of a hiccup in early July as the deadline approached. What's the view now on this whole piece in the US and the effect on global markets?
So we have got a close to 1% drag to GDP for the US this year over the next 12 months from tariffs. It's probably actually come down a little bit since the most recent announcements on Japan and maybe the EU. We're starting to see maybe signs that it's pushing inflation a little bit up. It's very early, but we're starting to see a bit of that coming through. That drag on growth is manageable in our opinion.
Yeah.
And I think one thing that's been notable is we've seen market reactions on tariff announcements have been pretty positive. So even Vietnam, when Vietnam got announced at 20 and 40, the companies that are big in Vietnam, so Nike, Lululemon, and Williams-Sonoma, they had really strong days. So they're coming in better than expected, even on those more aggressive measures.
Yeah. And more broadly, heading back to Australia now, we're all expecting to get an interest rate cut in July and on our mortgages, and that didn't happen. Are we going to see rate cuts later in the year as we may have forecast earlier this year?
Yeah, I don't think a great deal has changed with that pause. We had thought they would do July and then pause. I think they're doing the pause then probably August, maybe September. Why didn't they cut is a really important question. So they just want more confidence that inflation is going to be sustainably achieved at 2.5%, which is the midpoint of the target. And they just didn't feel that confident about that. One of the reasons they don't feel that confident is the labor market has been running still pretty tight. That changed in the month of June. So we actually saw the unemployment rate go from 4.1 to 4.3. That's getting pretty close to where they think is the neutral rate or natural rate of unemployment. And so I think as we sit here today, they're probably feeling a little bit more comfortable. The longer term dynamic that is still a problem for the RBA is productivity in Australia is really, really weak. And it means that you can't have much wage growth that isn't pushing inflation up because there's no productivity. That's a challenge. I think the government knows this. They've got this productivity roundtable commission. Like who knows what actually comes about, if anything. But people being focused on it is generally a better thing than not being focused on it. So that's going to probably keep them from going really aggressive on rate cuts over the next year. But 1 to 2 to get them back towards normal levels of interest rates or neutral is probably still appropriate.
Okay. And what should we look out for as investors and advisors? What are some of the signs we should look for to see that we will get a rate cut? Is it the unemployment rate kicking up and the inflation rate being stable?
So I think the unemployment rate holding at 4.3 or edging higher is probably the first tick, and it's probably a pretty big tick. On the unemployment, the inflation, I think seeing signs that the quarterlies are running at a rate that wouldn't get you above 2.5, that would be a pretty important development as well.
Yeah. And then finally, as you know, this is my favorite. We've still got 1 month of summer left in the Northern Hemisphere. And so Australian dollar strength, what's our view on the Australian dollar?
So we still think 70 cents is achievable. Might not be year end, might be Q1 next year. So I think over the next 6 months, we'll see that coming through. There's one big bit. So, going back to cycle value and sentiment, the sentiment on the Aussie is still quite weak. When we look at trader positioning, everyone is short. We're at kind of record shorts, and that dynamic is really good because all it means is that, it doesn't take much to push the Aussie dollar higher because everyone has to get out of that position. So that plus fair value being at 70, 71 plus potential more China stimulus, that gets you to 70 cents, I think, by year end, if not Q1.
Okay. So, Alex, my usual question, we're walking down the street and we've got one block and you've got one block to tell me what's going on. What are the 3 things I need to watch for in tariffs, interest rates, and the Aussie dollar?
Yeah, okay. So for tariffs in the global economy is holding up nicely. We've probably gone through the worst of tariffs.
Yep.
We've gone through that. Interest rates will gradually be reduced from here, both in Australia and also in the US. So I think 2 rate cuts by year end, probably sensible. And then thirdly, if you're looking to travel, US traveling is going to look better in 3 to 6 months' time, in our opinion. And against the euro, you get a little bit, but it won't be as exciting in terms of upside. So a little bit upside against euro, but mostly against the US dollar.
Okay. So pack our bags for our Jetstar flight to Honolulu then.
Well, the prices in Hawaii offset any benefit you get from currency.
The island tax, the paradise tax.
Yes.
Well,
yeah.
As always, Alex, thank you very much for your time and thanks for joining us today.
Pleasure. Thanks, Neil.